The CARES Act Direct Payment Update. There are some planning opportunities to consider if you did not qualify for the direct payment or you received a partial payment based on your 2018 or 2019 tax return. A quick recap on what the payment is. The CARES Act direct payments are a prepaid 2020 tax credit, meaning they are based off of your 2020 income. So if you did not qualify for the payment based on your 2018 or 2019 tax returns and your income is within the limits on your 2020 tax return, you will get the credit. This will be great for anyone that has lost their job or their income has decreased in 2020. The bad thing is that you have to wait until you file taxes next year. The question you may be asking is, will you be required to pay back the credit if you received it but are over the limit based on your 2020 income? The CARES Act wording is not clear about if you will have to pay it back, but a Congressional Research Service report clarifies that the CARES Act does not require taxpayers to repay any advance refund payments if their 2020 adjusted gross income exceeds the income limits for direct payments received. This is good news. If you receive the direct payments but make more in 2020 that puts you over the threshold, you are not required to pay it back. Let me say that again. If you receive the direct payment and you win the lottery in 2020, you will not be required to pay back the direct payment you received. If you didn't receive the payment but your income is close to the cutoff, there are some things to consider to make you eligible. Quick recap of payments and who qualifies. The full payment amount is $1,200 per adult and $500 per child, ages 16 and under. You qualify for the full payment amount if your adjusted gross income is below the following limits: $75,000 for single, qualified widower, or married filing separate, $112,500 for head of household, and $150,000 for married filing jointly. The stimulus starts to phase out when your adjusted gross income is over the above limits at a rate of 5% for every $100 over. The payout is based on your 2019 tax return. If you had not filed your 2019 at the time the payments were made, it was based on your 2018 tax return. If you have no idea what your adjusted gross income is, you can find it on either your 2019 or 2018 tax return. On your 2019 return, go to Form 1040, page 1, line 8B. On your 2018 tax return, go to Form 1040, line 7. Here are some things you can do to lower your adjusted gross income. These also will work if you received a partial credit. The easiest way to lower your adjusted gross income would be to contribute to your employer-sponsored traditional 401k plan. Remember, traditional 401k contributions, you don't pay taxes on the money today, but pay taxes when the money is withdrawn. In 2020, you can contribute up to $19,500 and an additional $6,500 if over the age of 50. If you have a health savings account, they work the same way as a traditional 401k, lowering your adjusted gross income by what you contribute to it. In 2020, the maximum annual contribution for families is $7,100 and an additional $1,000 if you're over the age of 55. The CARES Act allows anyone not itemizing deductions to take up to a $300 charitable gift deduction per tax return. Most people don't itemize anyways, so this is a good benefit. It has to be a qualified charity. There's a link in the description of where to look up a qualified charity. An example of how all this would work. In 2020, say you're age 34 and are married filing a joint return, and you maxed out all of your options. Your adjusted gross income was $200,000 on your 2019 tax return, excluding you from the stimulus. But your household income fell to $175,000 in 2020. You contribute in 2020 $19,500 to your traditional 401k, $7,100 to your health savings account, give $300 to a qualified charity. That gives you $26,500 in deductions to your income. Take your income of $175,000 minus the $26,500 in deductions. This will give you an adjusted gross income of $148,100, entitling you to the full $2,400 stimulus tax credit. Suppose you have children ages 17 or older or qualified relatives that you claim. You did not receive the $500 credit based on your 2019 tax return. If you don't claim them on your 2020 tax return, they can file their own tax return in 2020 and be entitled to the full $1,200 tax credit. Since it is a refundable tax credit and does not have a minimum income requirement, they are eligible to receive the full credit. In most instances, it will be more beneficial for a child over the age of 17 and qualified relatives to not be claimed as a dependent in 2020. Keep in mind, there are certain situations where it will be more beneficial to claim your child or qualified relative and forego getting the $1,200 stimulus. An example would be certain college tax credits benefits like the American Opportunity Tax Credit. Look at your previous tax return to see if you are already receiving a tax benefit, or do a quick internet search to see if you are eligible for one. Also, if you had a child in 2020, or if you did not receive the $500 for a qualified child during the first round of payments, you will receive the $500 when you file your 2020 tax return. That's it for this video. Please hit the like button if you enjoyed it and consider subscribing to the channel. I am also on Instagram and TikTok. See you next time.